Hello, members one and all of the Salivation Nation. Are we on the prelude to an economic recession, a deep recession? Um, well, according to some of these articles I'm going to look at today, there are some warning signs and some red flags that are coming up, especially as investors start to pull billions from U.S. stocks and longest outflow streak since 2004. This article from CNBC talks about the different activities they've been having for 10 straight weeks of withdrawals, longest in more than a decade of internal positioning changes. And it indicates that investors are becoming more defensive. Yeah, we've seen the stock market certainly up on its highs and the like over the past several months here. And what early on for 2017 was known as the Trump boom. But nonetheless, investors are fleeing U.S. stocks now in a way they haven't since 2004. For 10 straight weeks, a total of $30 billion has left U.S. stocks, marking the longest streak of outflows since 2004. Bank of America, Merrill Lynch said on Thursday report, citing EPFR global data. Investors turned instead to emerging markets and European and Japanese stocks, which saw $36 billion in inflows over the last 10 weeks, the report said. And of course, when you read that, you think, well, maybe the euro against the dollar, maybe some of the reason they're just positioning to where things are cheaper overseas. But the OFAML's breakdown of last week's fund flows pointed to more aversion to risk among investors and could add to some analysts' worries about deteriorating market internals. And here we can see in this chart the different spikes and periods where you've had weeks of consecutive U.S. fund outflows. And you can see here in '04, there's no really reason or explanation for that, but here we can see, and there's no recession that occurred then, but in 2008 and 2009, we saw obviously a lot of outflows, U.S. fund outflows, all the way through that period. And then here we see the 2015 market peak is the reason for this in 2015, and then the Shanghai Accord in 2016. And we have the 2017, which is a strong spike lasting for 10 weeks. It's a very interesting indeed. The 10-week outflow from U.S. stocks comes despite the S&P 500's nearly 1% gain this quarter and a record high on August the 8th. The report also pointed out the turn away from U.S. stocks coincided with a late June surge in the euro against the U.S. dollar to its strongest in nearly a year after comments from European Central Bank President Mario Draghi suggesting higher inflation and tighter monetary policy soon in the Eurozone. Maybe they want to take advantage of that. The euro subsequently climbed to its highest in more than 2 years in early August and traded slightly below those levels at near $1.186 Friday. Draghi is scheduled to speak later Friday afternoon at an annual meeting of central bankers in Jackson Hole, Wyoming. In the week ending Wednesday, European stocks saw the first outflows in 7 weeks, the Bank of America AML report said, while Japanese stocks saw their largest inflow in 5 months at $3.1 billion. And here we see a chart showing major global indexes performances. And you can see obviously the Asian markets here, India, Brazil, NASDAQ Composite are showing obviously some highs here. Major contributors to the U.S. stock market gains in the last several months saw significant outflows in the week ending Wednesday. The report said technology $600 billion, financials $35 million, 600 million, 35 million for financials, consumer 1.5 billion, the third largest ever. So it's quite interesting. The defensive utility sector was the only U.S. stock sector to see slight inflows in the last week. By investing style, investors withdrew $1.6 billion from U.S. growth stock funds and $1.1 billion from U.S. value stock funds. Only U.S. small caps saw inflows. Investors also piled into treasury bonds, which saw the greatest inflows in 10 weeks at $900 billion. So it seems like they're moving towards more safer assets here, or safer investments and the like. And it's quite interesting indeed. This is definitely weaker U.S. equity inflows, but still has positive, in my sense, that its positioning is still long, and the volatility index backs at 11 shows are still complacency. So we may be at the precipice of something, but right now, nothing's really happening to cause a whole lot of concern right now. But it's just one sign, or maybe a few signs. He estimated U.S. stock exchange traded funds, passive investment products, which have risen in popularity over mutual funds, gained $6.1 billion in net inflows since June 30th. In addition, the BOFAML said its proprietary bull and bear indicator did not trigger a sell signal, meaning the market still remains in a rally mode. And that's the thing. It's just psychology plays a great role in this, and that is the case with the volatility index, especially when it's over 10. And while overall the bank's wealthy private clients turned more defensive, their allocation to one traditional safe haven, precious metals, ETFs, has fallen to record lows, Bank of America and Merrill Lynch said. Check this chart out. This is interesting and fascinating. You can really tell a lot from this graph here. This is the private client allocation to precious metals ETFs as percent of assets under management. Now look here. You can almost tell the story. You can see the story of precious metals by looking at this chart here. Even though it's ETFs, this is not the physical. And that's going to be something that I'm going to talk about in a later video, actually, with ETFs. But check this out. Very interesting. Here we have 2009, which was the start of the effect of the Great Recession. And we can see here that people were looking for safe havens, and look where it was, just under 5% then. So even with the economy doing relatively well up to that point, people were still holding well over 4%. Into the precious metal ETFs, and then look, they skyrocket up through the recession, and then we see them moving along with the prices holding steady but climbing a little bit, and then boom, in 2011, look at that big spike. There's one of those classic signs where people were buying high and selling low, because look what happens. People started to sell low there when prices dropped, when they really should have been selling up here, but they ended up selling and then coming back around. And then look here, it spiked up big time in 2013 when we saw those big price drops. So they learned their lesson and started to buy low and sell high. And then since the precious metal started going down, we saw a drastic incline of ETFs there. And I think but of course, there's been talk that there's a lot more ETFs, much more paper silver and gold than there is actual physical gold and silver. So people may be losing confidence in the ETFs. Who knows? But we saw it did kind of recover a little bit as the price has kind of gone up a little bit. I know it did get up over right around $20 sometime in 2016, and now it's coming back down. So we're at just over 1% here. Precious metals allocations, which coincides with that volatility index, because investors, they want to go where the money is making them, where they're making the money. And precious metals is not a money maker. It is a money preserver. It's a wealth preserver. And I think that most people that invest in these ETFs see them as just kind of it's a safe haven. They understand that. And so they're able to take more risk, especially with this rallying market these days. This article from Bloomberg talks about the Wall Street banks are sending warning signals. And very interesting indeed here. And number one, there's 5 of them. We could be close to a downturn. The rally looks like it's about to peter out, say analysts at banks like HSBC Holdings, Citigroup, and Morgan Stanley. They're looking at the relationship between stocks, bonds, and commodities, and they're worried people may be ignoring fundamentals, just like they did in the run-up to the 2007 crisis. Investors are pricing assets based on the risk specific to an individual security and industry and struggling off broader drivers. And here we can see the U.S. business cycle dating based off profit margins here, pre-tax. And then the new iPhone won't blow you away. Now, this is an interesting point, not with anything revolutionary in a way. There's still a lot of sizzle and improved features with the iPhone 8. The device will be more powerful, the camera will work better, and you'll be able to unlock it with your face. Some of the other stuff, however, is already on rival phones. Wireless inductive charging, an almost all-screen front, an OLED screen. We don't feel an impatience to be first, Apple CEO Tim Cook told Bloomberg. Our thing is to be the best and give users something that really makes a difference in their lives. And then number 3 is to track climate change. Listen to the frogs. Well, this is an interesting point. This company is like Shazam for animal sounds. Wildlife Acoustics based in Massachusetts sells devices that record bird airies, frog croaks, and whale songs and more. There are 36,000 of them out there all over the world, with North America, the North Pole, used by scientists to listen in on the environment. One lesson: pay attention to the frog. Its disappearance from a habitat is an early warning that the place is becoming deforested, drier, or simply hotter. And of course, I don't really know how that plays into economics or what have you, but nonetheless, it's something to consider and to think about, I guess. I don't know. And then number 4, the U.S. Navy is shrinking. There have been 4 serious U.S. naval incidents in the Western Pacific this year, putting a spotlight on the overstretched branch of the American military. After the most recent collision involving the USS John McCain, some experts are speaking out about the increased burden of the Navy is carrying. The Navy has 271 ships in 2015, 20% fewer than in 1998, and still kept 100 ships out at sea, according to Brian Clark, a senior fellow at the Center for Strategic and Budgetary Assessment. Something's got to give. But the thing is Trump is talking about expanding the military, so that point really doesn't make sense. And then, so some of these points I'm not really sure are really applicable. Maybe the iPhone one, if people weren't as excited about the new iPhone, it could have some effect maybe in sales, which could cause some, which could hurt their stock. But I think there's other things happening. There's a hurricane about to hit and in Texas, and if it turns out to be really bad, it could have some effect. But in other ways, hurricane recovery stimulates other parts of the economy. But nonetheless, some things to consider. I think that chart here on the other article, especially concerning precious metals, is quite telling, which leads me to think that, sort of a reinvigorated confidence in the metals and that it's a good buy. So post your thoughts below on this news, and what do you think? Do you think we are at a prelude to a great recession or a deeper recession than before? I'd like to extend the multitude of gratitude to you all for watching. I encourage you to please rate, comment, and subscribe.